Well, let's start with the second half of our morning at Quant 2025, and we're really delighted to welcome back at Quant Paul Wilmott, who's researcher, author, one of the best experts in quantitative finance and investing, and he's a kind of a regular at Quant. So welcome back, Paul Wilmott. The stage is yours. Facciamogli un applauso. Let's have a round of applause. Thank you, Paul.
Thank you very much. I really like Italian audiences because you're always very friendly, especially to strange new ideas. So go gentle on me. All you seem to think about is money. Have you noticed that? From the talks today so far, money, money, money. Well, I'm going to talk about how money can make you happy, in a sense. As well as AI and crypto, we also hear a lot about behavioral finance. And that's what I'm going to be doing here. A little bit of very basic behavioral finance. But also, because I'm a mathematician, there is going to be some mathematics involved. Okay? Who here is a mathematician? Okay, mathematicians are very shy people. Who here is a mathematician? Okay, didn't change much. Anyway, the maths is going to be very, very simple. I'm going to start off with some little bit of maths that you should really ought to know, and that is a recap of some basic portfolio management ideas, modern portfolio theory and Kelly. I'm going to rattle through those really quickly. You really ought to know these things if you're working in finance anyway. Then a tiny bit of behavioral finance, including a reference to James Bond. And then a very simple model for happiness and how money affects that in a sense. All right, modern portfolio theory. Who knows all about modern portfolio theory? Oh, that's very disappointing. Who doesn't know? Yeah, very good. Who doesn't know about modern portfolio theory? Okay. Right, modern portfolio theory is a very simple idea. I'll go through it very quickly. If you put all your money in one investment, it may have a great expected return, but there's a lot of risk. However, if you spread your money around amongst lots of investments, you may still get the same expected return, but with less risk. Think in terms of, you've got a coin, it's biased, it's 55% chance of getting heads. If you put all your money on that one coin, then you may double your money, but equally, well, not equally, but still 45% chance of losing all your money. But if you spread your money amongst 100 such biased coins, the expected return doesn't change, but the risk drops dramatically. That's very simple. And out of that comes the idea of the capital market line and the Sharpe ratio. Who doesn't know about the Sharpe ratio? Good. The Sharpe ratio comes out of that. Very good. And then you have what's called the efficient frontier, which tells you how the best portfolio for maximizing your expected return given a level of risk. And then you get the capital market line, which tells you if you combine the risk-free investments, all the possible returns you can get. But what it doesn't tell you, what this Nobel Prize-winning theory doesn't tell you, is how much money to invest. It says that if you invest a little bit, you'll have the same Sharpe ratio as you invest a lot. It doesn't tell you anything about how much to invest. So now, Kelly investing. Who knows about Kelly? Okay. Now this predates modern portfolio theory. It's known by all successful professional gamblers. Do we have any successful professional gamblers in the audience? Do we have any unsuccessful? Oh, we have one. Do we have any unsuccessful gamblers in the audience? Very good. The Kelly criterion is not so well known amongst finance professionals, but it's even easier than modern portfolio theory. It says if you invest a certain fraction of your money on some risky bet, it's got a positive return but some risk. It tells you how much you should invest, what fraction you should invest if you want to maximize your expected return. The maths is absolutely trivial. The fun thing is this, that you find that if you invest too much you've got a biased coin, again. You might think, oh, I've got a 55% chance of making money. I'll bet loads on this coin. Well, it turns out that if you bet too much on this coin, a fraction of your wealth on this coin, your expected return becomes negative. Now, the idea of this seems counterintuitive. You've got a positive expected return. The more you bet, surely the bigger your expected return is, right? Well, no. Just think in terms of this. Suppose you've got $100, and you bet on a coin with a slight positive edge, but a tiny positive edge, and you bet 10% of that $100. If you win, you have 110. Okay, so now you bet 10%, again, the same fraction, which is $11, but now you lose. So you've gone from 100 to 110 down to 99. So you can see that if you're betting the same fraction and it's too much, then you get negative expected return. Okay, those are the two important ideas. This kind of tells you how much to bet. Neither of these tell you anything about how happy they make you. So we come to James Bond, and there's this quote. Who's read Moonraker? Who's read Moonraker? Not seen the film. Who's read Moonraker? Has anyone read any Ian Fleming? Okay. Have you read Moonraker? You haven't read Moonraker. There's a great quote in Moonraker. I'll read it out. They had said goodnight, and Bond, in a mood of anticlimax, had gone off to bed. He had taken a mild sleeping pill to try and clear his mind of the bizarre events of the evening and prepare himself for the morning and the office. Before he slept, he reflected, as he had often reflected in other moments of triumph at the card table, that the gain to the winner is in some odd way always less than the loss to the loser. What that means is, and it's a couple of, a Nobel Prize winner rediscovered this later, but it was originally down to James Bond, that the empirical evidence is that if you make some money and then lose some money, the same amount, you're emotionally down. You have to make up twice as much money, say the next day, as you lost to be emotionally level. So in James Bond, it was Hugo Drax who'd been cheating at bridge, and James Bond had a stacked deck, and James Bond won the $15,000 from Hugo Drax. So in order for Hugo Drax to be happy, he would have to make $30,000 the next day. Now that's empirical evidence that this 2-to-1 ratio, and anyone who's experienced winning and losing at the card table will know about that. All right. So this is the sort of thing you see from prospect theory, some kind of value function, loss, gain, but the downside is worse. And typically, you need to make twice as much money to be emotionally neutral. So, for example, we're going to have a quick just a little demonstration. So here's a simulation of a stock price. The stock price has gone up a bit, then it levels out. It's gone up quite a lot within just a few months. Now, suppose you start looking at your P&L. If you look at your P&L not very frequently, you see you're very happy, according to this 2-to-1 ratio. If you start looking at your P&L more frequently, what happens is your happiness goes down, becomes very negative. The reason for this is because every time you observe your P&L, if it's gone up, you're happy. If it's gone down, you're really unhappy. So even though in this particular simulation the stock went up 30% but then leveled out, the net result is unhappiness. Okay, because you're just looking at your portfolio too often. If you can just hold tight and not look at your portfolio, then you'll be much happier. It's the same with investing in art or wine or property. You never really know what the value of your art or wine or property is until you come to sell it. So you can be very happy for a while. Ignorance is bliss, of course. So that's the theme of what we're going to be doing now, which is the mathematics of how happy you will be dependent on how frequently you observe your portfolio. This is really, really, really easy. Very easy stuff. We're going to have some returns in excess of the risk-free rate, some happiness function. I'm going to keep it simple to start with. So we have pictured something like this. We have the normal distribution. That's the blue curve. That's the probability density function for the normal distribution. So I'm assuming normally distributed returns. The orange line is our happiness function. You see that it's keeping it simple for the moment. It doesn't change much if you make that more complicated, but just straight lines, but with different slopes. The key thing is different slopes. The slope on the downside is twice that on the upside. Very simple stuff you can do, expectations, normal distributions. That's one of the, I wrote a paper about 5 years ago on this sort of thing, but it was really complicated. So that one of the ideas behind this was to streamline it, make it very simple. What you end up with, I'll just give you, I'll jump to the sort of some simple formulae, if you like formulae, the formula in here. The key thing is, in all these formulae that tell you how your level of happiness, the key thing is a Sharpe ratio again, or a scaled Sharpe ratio. It's the Sharpe ratio. Mu is the expected return in excess of the risk-free rate, and tau, the Greek letter tau, is the time between observations. Okay, so you take your Sharpe ratio, multiply it by the square root of the observation time, and that's a dimensionless quantity. And so that time-scale Sharpe ratio is what dictates everything. So it's kind of nice that the Sharpe ratio, which appears in modern portfolio theory, and it appears in Kelly stuff, it appears here. Even if you don't have a linear function, you get the Sharpe ratio coming out. Okay, so this is the sort of thing that happens. Let me go straight to the bottom. Suppose you have, for example, let's show you how you use this. Suppose you have an expected return in excess of the risk-free rate of 8%, and you have a volatility of 15%, so you can calculate your Sharpe ratio. In order to be happy, and if I go back a little bit, there, that's actually the picture I should have shown you. This is your expected happiness as a function of tau, which is the observation period. That's actually the most important picture that I somehow skipped. If you observe it very frequently, tau is very small. The bottom left-hand side of this. If you observe very infrequently, you're at the top right. And so you see there's a cutoff at about 0.27. Oh, sorry, cutoff. It crosses the axis at about 0.27. In other words, you need, and that's with the parameters up there, 8% and 15%, you need to observe it less frequently than once every quarter if you're going to be happy. All right? So 0.27. So if you have those parameters, then 0.2, you can't look at your portfolio too often or you will be miserable. Does anyone relate to feeling miserable? I know you relate to feeling miserable. We talked about it. If you observe too frequently. But the maths is trivial. Now, what about beating an index? Because you don't just want to beat the risk-free rate of return, right? You want to, if you've got investors, and I used to have investors, and I used to, every month I would go and speak to investors, and it was a horrible experience. It was kind of like having a boss. And I've always worked for myself, so I've never actually had a boss. But I imagine the experience, is it awful having a boss? Yeah, you can't say, right, because your boss is sitting next to you. I know. Okay, anyways, I imagine it's miserable. So they also want you to beat some index. And the mathematics is equally simple for beating an index. Now, instead of the simple Sharpe ratio, you have this Sharpe ratio here. And here's some numbers, for example. I just taken I've taken some numbers from the NASDAQ, some shares from the NASDAQ, and compared it with the NASDAQ. And the idea is to try and beat the NASDAQ. And we get some numbers down here, say for Apple, for example, given the growth and the standard deviation, the time period over which you must look at your portfolio, if it's just Apple, 1.19 months. In other words, if you look at your Apple shares every month, you're going to be unhappy. Now, looking at all of those, you can see that Cisco is terrible. Qualcomm, Starbucks, terrible. Starbucks, you can only look at your portfolio your Starbucks shares every 6 months. Otherwise, you'll be miserable. The closest, if you're monitoring your share price every month, or you're going to your investors every month, which is sort of typical, and groveling to them and explaining why you haven't made as much money, or you've lost money, or can they give you more money, or whatever. If you're visiting them every month, the only one that almost will make them happy is Amazon. Boo. Amazon. I hate Amazon. I'm addicted to Amazon, but I hate it. Then if you look at compare it with the index, if you want to try and beat the NASDAQ index, what comes out of this is, for example, Cisco, Qualcomm, Starbucks. You can never be happy, never. It doesn't matter how infrequently you look at your portfolio with those stocks. You can never be happy. But again, the best, AMD, 1.5 months. And that's all because of these numbers are different because of the correlation between these stocks and the and NASDAQ. Here's a sort of lovely, I'm just going to finish off with a couple of pictures. This picture is the red line. So this is expected return against risk. So this is the classical modern portfolio theory picture, augmented with the happiness stuff. So the yellow dots are the individual stocks. The red line is the efficient frontier. The green dot is NASDAQ, which isn't. I haven't included that in the optimization. The blue line, the dark blue line, is the capital market line, which goes through the red dot, which is the tangency portfolio. So classically, what modern portfolio theory says is you should combine the tangency portfolio with the risk-free asset in whatever fraction you deem fit, depending on how much risk you want to take. But there's also on this, there's the lighter blue line, and that gives you the minimum observation period, and that's the axis for that is on the right-hand side. That means it's the period over which you've got to look at your portfolio, or you have to look at your portfolio longer or less frequently than the minimum observation period. So, for example, the very bottom there, and that's in months, the very bottom, that it has a minimum at about 0.45 or something. That means the portfolio you want to pick, if you want to be happiest every month, is actually not the tangency portfolio. It's actually that blue dot. Okay, so it's a slightly different optimization, a slightly different calculation you do here than you do for the modern portfolio theory. Okay, so the idea is if you're trying to be happy, you do different things than if you're a machine trying to make lots of money. So slightly different. So there's the portfolio. How you split up your portfolio if you're trying to make yourself as happy as possible. So the idea is, if you are going to, you're speaking to your investor, and it's not necessarily that you want to be happy, but you definitely want your investor to be happy. All right. So this is what you should do if you want to make your investor happy. And there's a pretty picture. That's just this minimum observation period as a function of the Sharpe ratio. The tangency portfolio is it turns over, but there's a slightly different portfolio, which is the one that will make people happiest, your investor happiest. Okay. Oh, here's a good one. What's this famous Sharpe portfolio? What's this? This has a Sharpe ratio of about 3. This is a great portfolio, famous portfolio. Sharpe ratio of 3. It means you could look at this portfolio how many times a week? Twice a week and still be happy. Do you know what that is? Yes, exactly. It's Madoff. Okay, so there's a little bit more to this story than just the maths. But it's the whole point. You'd be happy. You'd be really happy right until the end. It's like with investing in art or wine or property. You'd be happy right up until the crunch. Okay? And now what? Wondered Bond. He shrugged his shoulders to shift the pain of failure. The pain of failure that is so much greater than the pleasure of success. Moonraker. So, just finish off with the important ideas. Common experience that downsides are more painful than the upside are pleasurable, typically with a ratio of 2 to 1. So if you monitor your P&L too frequently, or your investor monitors your portfolio too frequently, you will just be miserable. You see the Sharpe ratio appearing again, which is nice, or in particular a time-scaled Sharpe ratio, having within it the observation period. And part of this is you can adjust your portfolio in favor of happiness rather than just making lots of money, as a thought. Eh? Oh, I didn't mention that. The martini should be shaken, not stirred. Okay. But you knew that already, I think. All right. Thank you very much for your tolerance.